Down 1.7%.
3 and 4.5%. We're red everywhere, essentially, down by 4-5%.
We're down over 16%, 18%.
I hope I'm wrong, but I think we're heading for a global depression.
America is now bankrupt.
From a market crash that's inevitable to how we can't save ourselves from it, let's talk about how the stock market crash is coming. In the fourth quarter of 2023, America's GDP grew by 3.3% annually, signaling positive economic growth. This news has positively influenced the US stock market, with the S&P 500 index showing a 1.6% increase year to date. On top of that, on January 25th, the Dow Jones Industrial Average closed about 38,000 for the first time, and on January 29th, the Nasdaq Composite reached its highest close in 2 years at 15,628.04. However, times are still a little tough for consumers, particularly concerning high grocery prices. While overall food prices rose by 2.7% from December 2022 to December 2023, some essentials like eggs and lettuce have decreased in price, while others like beef and sugar have risen. Oh, and record high home prices, labor volatility leading to significant layoffs, and stagnant wages contribute to consumer concerns about the economy in early 2024. These factors create uncertainty for the US stock market, especially in the middle of an approaching volatile presidential election season. Steve Cruz, a mortgage lending specialist and founder of Golden Road Reborn, has said that the market outlook for 2024 can be a bit shaky. You see, some people anticipate a flat or downward market in the first half due to high inflation, recession fears, and potential rate hikes from the Federal Reserve. On the other hand, however, there are some people who are hopeful enough to foresee a continuing bull market because of potential Fed rate cuts, earnings growth, and historical trends around election years. But let's dive into why the stock market crash is coming. High stock valuations. In 2024, the stock market's performance is expected to be influenced by fluctuations in interest rates. Currently, the S&P 500 is trading at a higher valuation than its long-term average, with a forward price-to-earnings ratio of about 20 compared to the usual 16. This means that stocks are relatively expensive compared to historical norms. On top of that, the equity risk premium, which measures the reward for owning stocks versus risk-free investments like treasury bonds, is at an unusually low level of around 1 percentage point. According to Lisa Shullett, Chief Investment Officer at Morgan Stanley Wealth Management, this high valuation could impact stock performance throughout the year. Looking ahead to the end of 2024 and into 2025, projections suggest that annual stock returns may be lower than the long-run average. Historically, gains have averaged around 7 to 8%, but with current valuation levels, they are estimated to be closer to 4%. These insights highlight the importance of considering valuation metrics and interest rate movements when assessing the outlook for the stock market in 2024. Overdependence on leading stocks. In 2023, 7 tech giants known as the Magnificent Seven, Alphabet Incorporation, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla dominated the stock market. Their collective performance propelled the Bloomberg Magnificent 7 Total Return Index to a remarkable 107%, far outpacing the S&P 500's 24% growth. David Pollock, equity investment director at Capital Group, attributes this success to the strong fundamentals of these tech giants, particularly their early investments in artificial intelligence. Their substantial market capitalizations also played a significant role in driving the overall performance of the S&P 500 index. However, there's a catch. The bulk of the stock market gains in 2023 came from these 7 companies. If their performance deviates from the previous year's exceptional results, it could lead to overall market underperformance in 2024. This underscores the importance of monitoring the performance of these tech giants in the coming year. Wishful thinking on interest rates. Investors are hopeful that the Federal Reserve will lower interest rates aggressively throughout 2024. However, Lisa Shullett from Morgan Stanley doesn't think this optimism is entirely realistic. She points out that while the Fed has indicated its intention to cut rates 3 times this year, futures markets are pricing in more than 6 rate cuts. This assumption relies on the belief that the Fed will effortlessly control inflation, but Shullett believes that inflation in labor-intensive services could still remain a challenge. Consumer exhaustion. In the third quarter of 2023, credit card delinquencies rose across the board, according to the Federal Reserve Bank of Philadelphia. This includes debts that are 30, 60, and 90 days overdue. Also, consumer non-mortgage interest payments increased by 50% compared to the previous year, surpassing $1 trillion in Q3 2023 as reported by the US Bureau of Economic Analysis. Experts like Charles Schwab investment strategists Liz Ann Saunders and Kevin Gordon highlight a concerning trend of consumers living beyond their means. This is particularly evident in rising revolving credit and serious credit card delinquencies, especially among younger borrowers. While wage growth has helped keep the ratio of credit card debt to compensation relatively low, any further weakening in wage growth could cause this ratio to rise. Given that consumer spending makes up about 70% of GDP, Saunders and Gordon emphasize that downbeat consumer sentiment could have a significant impact on stocks. Stubborn inflation. Currently, the US inflation rate, measured by the Consumer Price Index, also known as the CPI, is at 3.4%. The Federal Reserve anticipates inflation to drop below 2.5% in 2024, still above its target rate of 2%. It's important to note that the Fed prefers to use the Personal Consumption Expenditures Price Index to gauge inflation. Some experts point out the connection between worker wages and inflation, which remains high in early 2024. Average hourly earnings growth in the US is about 4%, a figure higher than what the Fed prefers. Eric Friedman, Chief Investment Officer at US Bank Wealth Management, explains that the Fed aims to bring inflation closer to its target of 2% per year. The question remains how much further inflation needs to stabilize before the Fed considers adjusting interest rates. A roiling 2024 presidential election. As the 2024 election season begins, the Republican Party looks poised to nominate former President Donald Trump, while the Democratic Party stands firmly behind President Joe Biden. However, both candidates are experiencing lower polling numbers, which is causing concern among investors. Historically, major election years have had a significant impact on financial markets. According to Greg Sweeney, Chief Investment Officer at Bell Bank, stocks have typically rallied in the year following an election despite initial volatility leading up to Election Day. While the Federal Reserve is holding off on rate hikes, the uncertainty surrounding the election could further increase market volatility. JP Morgan Wealth Management investment strategists Madison Fowler and Sean Snyder say that investors consider opportunities in higher-yielding assets like municipal bonds, which offer tax advantages and limit default risk. Now that we've talked about all the reasons why a stock market crash is coming and what the experts think, let's talk about how you can save yourself from this crash. Steps to crash-proof your investment portfolio in 2024. In 2024, despite the Federal Reserve's strategy of keeping interest rates higher for an extended period, and despite some uncertainty, there are still opportunities for investors. First of all, government bonds are valuable due to their yields exceeding inflation, making them potentially appealing as a hedge against stock market volatility. Oh, and quality equities are preferred for their relative value and defensive characteristics. Real estate investment trusts and global listed infrastructure are also attractive investment options due to longer demographic and technological trends. As the year goes on, you all should focus on asset allocation, considering portfolio diversification and active management. We can't emphasize enough the importance of addressing broader macro factors like inflation, growth, and trade, suggesting next-generation diversifiers such as real assets and private credit. Investors should also monitor stock market breadth, which refers to the participation of various market indexes, sectors, styles, and individual stocks in the market's uptrend. Thomas Samuelson, Chief Investment Officer at Vineyard Global Advisors, highlights the importance of a broad-based rally across small-cap, mid-cap, and average US stocks, as well as foreign developed and emerging stocks for a healthy bull market. But the question is, what are you doing to make sure you are protected against this crash? Let us know in the comments and subscribe to our channel for more videos just like this.